Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. So today's topic is tax implication on assignment deals specifically for pre-construction homes. Now, but before I get started, make sure that you give us a thumbs up and hit the subscribe button if you want to stay on top of the latest tax tips. So you real estate investors that are not able to close the upcoming purchase of your pre-construction home, and are you looking at options to sell the pre-construction home? And if that is the case, what are the tax implications? Do you know that you could be exposed to HST, you could be exposed to income tax implication that you are unaware of? Today's video, I'm specifically going to talk about the tax implication on assignment sales before closing. Let's start by discussing what assignment sales is for pre-construction home. Typically, when you purchase a brand new home directly from the builder, you would enter into an agreement of purchase and sale, say, today. And the property would not be ready to close, would not allow you to rent it out or move in until like 2 years, 3 years, or sometimes 5 years, sometimes 7 years down the road. So when you purchase the property, you sign the agreement of purchase and sale, you give the deposit according to the schedule as required by the builder, and you give the deposit to the builder, and the builder turn around and deposit it into the trust fund of the lawyer's office. And you have this agreement of purchase and sale. Typically, there are a lot of delays, and with delays, things change in your life, and you may or may not be able to close the property 5 years down the road. Now, 5 years from now is a long time. You decided that maybe this is the time to sell the property before closing because interest rate has gone up substantially and you don't know if you would be able to qualify for the property, or you are no longer requiring to move into a one-bedroom condo. Now you have a bigger family, you have a family of 4, you cannot fit everyone into a one-bedroom condo. So life circumstances may cause you to change your original intention or original plan. And so you decide to sell this pre-construction contract that you have. You pay the deposit to the builder, and now the property has gone up in value, and you want to be able to assign it to someone else. And this is, in a nutshell, what an assignment sale is. You sell a property as assignment before closing, before the property closed. And there are tax implications depending on what happened and what your original intention is and the date of the transaction. Now, let's just talk about the two types of tax implication. The first one is the income tax implication, and the second one is the HST tax implication. Now, let's begin with HST tax implication. Now, the first decision that we have to decide is, when did your assignment sale happen? Did it happen on May 6, before May 6, 2022, or did it happen after May 6, 2022? If your assignment agreement, the assignment sales that happened before May 6, 2022, this year, then you have to decide what are your original intention. You have to be able to prove the original intention to CRA. If your original intention is to use the property as your primary place of residence, or have your family members use it as the primary place of residence for your family member, if that is the case, then there is no HST implication on the assignment sale. If your intention was to use the property as rental and you decide to sell the property as assignment, the assignment fee is subject to HST. And it not only does the assignment fee is subject to HST, the deposit that you get reimbursed by the future buyer is also going to be subject to HST. That is CRA's policy for any deals that happen before May 6. So you could imagine that the HST implication is substantial under this particular scenario. Now, using an example to explain, let's say you purchase this Toronto condo and for whatever amount of money, and you put the deposit down, and the deposit amount is $100,000. Now you're able to assign the property for $50,000 more. So you collected the assignment fee for $50K. If you do your assignment before May 6, and you intend to use a property, original intent for that particular purchase was used to as the primary place of residence for you or your family members, this deposit and the assignment fees, the $100,000 and the $50,000, they're not subject to HST. There's no HST implication. There is definitely income tax implication, which we will get into later on. So with the same scenario being applied, if you did the assignment deal before May 6, 2022, and you didn't intend to use it as the primary residence for you or your family, then the HST would be applicable on the assignment fees as well as the deposit. That's currently what the CRA's policy says. So what it means is that the entire $100,000 and $50,000 that you got from the buyer would be subject to HST in Ontario. In the whole Canada, that HST is not applicable. In the provinces that HST is not applicable is only 5%. Let's say you do that $100,000 and $150,000. That $150,000 has an HST of approximately $17,000. $17,000. You thought that you collected $50,000 and you made $50,000 on the sale. The reality is that this assignment fee, $50,000 less $17,000, you really net $33,000. And you could also incur real estate agents' fees, and you could also incur other fees in terms of the sale of this assignment. So you actually you may not net anything from doing the assignment under this particular scenario. Now, you may say, wait, hey, Cherry, wait a minute. This deposit amount, this $100,000 deposit amount that I collect through my buyer, the assignee, we already paid HST on it. Why are we being charged HST again? Well, this is the CRA policy. I'm just the messenger. And actually, as a matter of fact, the government recognized that the HST has already been paid on this $100,000 deposit because it formed part of the purchase price of the condo. So in 2022, budget 2022, the government announced that for any assignment deal that happened after May 6, 2022, the HST would be applicable on assignment fees only. So it would only be applicable on this $50,000, not the $150,000. So you actually save a bit of money. The catch is though, any assignment deal that's executed after May 6, 2022, regardless of your intention, the HST would still be applicable. So it doesn't matter whether you're moving in as your primary residence or not, or you're using it for your family as their primary residence to stay. It doesn't matter. HST would still be applicable. If you take the calculator and you look at $50,000, $50,000 inclusive of HST of 13%, we're talking about $5,700, 5.8K HST. Whereas here, you're talking about $17,000 of HST. Substantial difference. You pocket an extra $12K just by executing your assignment contract after May 6. Now that is step one, the first tax implication on assignment sale. Okay, the second type of tax that you would be exposed on when you are selling an assignment sales on pre-construction home is the income tax implication. Now, the income tax implication, essentially, after you take into account the HST, you have to pay the government the HST layer first, and then the net amount would be reported on your income tax return. If you own the property on your personal income tax, then you would be subject to the respective marginal tax rate that you would be subjected on. And if you report you own the assignment, all these pre-construction contract in a corporation, then the sale would be subject to 12.2% for qualified Canadian control corporation. In a nutshell, what is the actual amount that you would be paying income tax on? Now, using the same example, if you have you assign a property to someone and your intention was to use it as your primary residence or use it as your family's primary residence, the assignment fee under this particular scenario happened before May 6, 2022. There's no HST. Then your assignment fee that you make is $50,000. You may have incurred expenses such as realtor fee to help you sell the assignment, and then the legal fees to enable you to do the sale, do the closing. So then whatever fees that would allow you to make that money, you would be able to deduct the expense. And then the delta, let's say is $20,000. The delta of $30,000 would be reported as capital gain. Now, why is it important that it is reported as capital gain? It is important because capital gain is only 50% taxable. So in this particular scenario, even though you made $30,000 after deducting all the expenses, you made $30,000, only 50% of the $30,000, so only $15,000 is considered capital gain and it's being added to your income. Now, on the flip side, if you are not using your property as your primary place of residence, that's not your intent. And your intent is really to use it and you are using it as inventory. You're selling it as your part of your business and you have history of selling the particular property on assignment all the time. CRA can argue this $30,000 that you make as income. 100% of that would be taxable. Now let's go through a scenario. So you're not using it as your primary residence and there's no change of scenario. You always intend to flip it. Under that scenario, you will have to pay the HST on assignment fees, which we calculated, it was $17,000. And the net amount that you pay would be $33,000, net amount that you collected, pocket. That $33,000 minus the $20,000 of expense, you would be netting $13K of income. The $13K, if it is not used as your primary place of residence and you intend to flip the property, that $13K is considered income, 100% would be taxable. If your marginal tax rate is, if you already earned income of $100,000 from your day job, adding another $13,000 means that CRA is going to take away 46%. Or so from that $13,000. And doing that whole deal means that you really net probably around $7,000. Even though you might have thought that you make $50,000, under that scenario, you would only pocket $7,000. So it's not as lucrative as you think it would be. Under the new rule, CRA also proposed some new rule in Budget 2022. The intention, whether you're using it as the primary place of residence, may or may not be affected by this particular new rule. It's still a fuzzy area and it's still up for debate because there was a new rule that came out essentially that says if you sell anything within 1 year of ownership, you're considered doing it as a flip property. So anything including rental property, if they are sold within 1 year after closing, they're considered flip property. And 100% of the profit that you make would be considered income. 100% of it is taxable. And therefore, because you're doing it as an assignment, it's before closing. The transaction happened before closing. But would CRA be able to deem that transaction as flip property? At this point, it is still unclear. So if your intention is primary residence, to use it as a primary residence, for yourself or your family members, which will give you the most beneficial tax treatment, you need to make sure that you document everything to make sure that you are stating all these documentation and providing evidence why and the circumstantial evidence why your intent is not carried out to prove that your original intention was to use it as your primary residence to give so then you can minimize the actual amount that you would have to pay in terms of income tax. So now after May 6, under this particular scenario, the same example, the deposit is $100,000, assignment fee is $50,000. That $50,000 net of the $5,800 of HST that you would have to pay, then that is essentially $44,000. That $44,000, if I'm using the same amount of expenses of $20,000, then you have $24,000 left. This $24,000 could be treated as capital gain or again, income, depending on your intention as well. It is arguable, like I mentioned earlier, depending on how the Income Tax Act is being written and how the income tax act is going to be carried out in terms of how they treat the assignment sale. Would they treat it purely as flipping income? At this point, we're uncertain. But going back again, based on current rule, it's really going back to your intention. Are you taking the property as your long-term rental or using it as primary residence, or are you treating it as a flip? That would dictate how this $24,000 is being reported, capital gain or income. It is a bit confusing, and it's okay. If you have questions, make sure that you leave it in the comment section below. Now that we have covered some extremely complicated tax concept on assignment sale, I know you have a lot of questions and I know it's confusing. So make sure that if you have questions, consult with someone who knows this area of tax, and make sure that you are staying on the right side of CRA. And if you find this video useful, make sure you give us a thumbs up and share with people who may be exposing to the similar situation. If you like us, make sure you hit the like button in the video and hit the subscribe button as well. Until next time, thank you for watching.